Inheriting a retirement account from a loved one can be a huge gift, but the IRS wants to make sure they get their cut, so there may be more to it than meets the eye. Since 2020, most non-spouse beneficiaries are subject to what's called the 10-year rule. The entire inherited IRA account has to be emptied by December 31st, up to 10th year after the original owner died. Like almost everything else in the tax code, there are exceptions. A surviving spouse can roll the money into their own IRA and treat it as if it was always theirs. There are also special rules for children or disabled individuals. I'll get to that on my blog. The other interesting exception is called the stretch rule. If you're not more than 10 years younger than the person who left you the IRA, so maybe a sibling or a close friend, for example, you can stretch distributions over your own life expectancy. This allows you to take those distributions over a longer period of time, but you will be required to take a distribution every year. Next little twist, if the original owner had already started taking required minimum distributions, which happens around age 73, the beneficiary must take RMDs during that 10-year window rather than waiting for year 10 to distribute the whole thing. And here's why spreading that money out is helpful. A traditional IRA is all pre-tax money. Every dollar you withdraw is ordinary income in that year. So let's say you inherit a $400,000 traditional IRA, you take it all in year 10. That $400,000 of income gets added to everything else you earned for the year. You could easily find yourself in the top tax bracket on most of that income. Spreading those distributions out over 10 years is usually the smarter move. Some use of distributions might push you to a 22% tax bracket, others might be a 12% tax bracket. The total tax hit can be significantly lower. That kind of planning has to happen before year 10, not in it. This is exactly where tax planning pays for itself. Now, if what you inherited was a Roth IRA, the 10-year rule still applies, but as long as the original owner had had the account for at least 5 years, every dollar comes out completely tax-free. You could let it grow for the full 10 years and owe nothing when you take it all out. The blog post this week goes into more detail on all of this, the exceptions in detail, how to calculate distributions, and what to think about when you're doing the planning. You'll find the link in the description. And that's the 10-year rule on inherited IRAs. Hit like if this helped you understand a rule that catches people off guard, and drop a comment below with a topic you want to learn about for next Tuesday.